Now, we are at my favorite subject, statement of cash flows. There are three parts, and I don't want you to have to sit for like 25 minutes to watch the whole thing, so I'm going to do it in three different sections. First section kind of explains the cash flow, then we're going to also look at the operating section, and then we will look at the investing section, and then the financing section. So that's kind of where we're headed with this. I hope you have as much fun with these as I do. So what are we going to do? We're going to look at the purposes and distinguish between operating, investing, and financing cash flows. And we're going to prepare a cash flow using the indirect method. And then we'll see how you use free cash flow to evaluate business performance. And then we're not going to do this, but know that there is a direct method for creating cash flows. It takes a bunch more time and is just as accurate as the indirect, but the indirect is so quick, many prefer it. So let's get started here. First of all, what are the purposes, okay? Let's look and see what the slide has to say. I feel like, who was it, Johnny Carson, who had the envelope, put it to his head and foresaw what was ever in the envelope. So let's see what the card says. So a statement of cash flows reports business cash receipts and cash payments for a specific period. It follows the income statement. Now, why this is my favorite report is because it is a lot more direct, and you can see exactly where the cash comes from. When you look at net income, that includes all kinds of non-cash items, depreciation, accounts receivable. Accounts receivable, well, it shows sales, right? A lot of that isn't in cash form yet. It's still in accounts receivable or on account. So you can use the cash flow statement, and it reconciles the income, net income, with the change in the cash. And it's really a fascinating statement. So it covers the same span of time as an income statement and is actually a complementary. Many investors go to the cash flow before they go to the income statement. That's how much it tells you about a company. Let's see, it says, this explains why net income as reported on the income statement does not equal the change in the cash balance. Now, if you were using a cash system instead of an accrual system, you would be very, very close, or you should be. Should exactly tell you what's going on in the cash flow, but we're not. We're using accrual. So you could say that the cash flow statement takes an accrual system in accounting and kind of switches it over to the cash and shows you the cash flow through. So what do? It helps predict future cash flows, typically. It helps evaluate management. It tells where the money comes from and how well they've managed the cash. And it does predict the ability to pay debts and dividends. You know, yeah, you've heard the phrase cash poor, you know. Land rich and cash poor. Many farmers have all of their money tied up in land and don't have enough cash flow sometimes to continue business, so they have to go out and borrow money to continue farming. Just an example. Well, the cash flow statement shows you how the cash flows through and where the cash comes from. So you can classify it, and we use three sections. Operating activities, which are current events, current assets, current liabilities, anything that is used in the operation of the business, the production side. Investing activities, those are where we buy and sell equipment or property. And then financing activities, we're looking at stocks, bonds, items and dividends, the equity section. So this is what a cash flow looks like. We start with net income, see it right here. Then we adjust for the operating activities, and I'll explain each one of these. But you can see we're adding and we're adapting or adjusting the net income. I'm adding back depreciation because that's a net income, but it's not a cash item. I'm taking away that gain because that's going to be shown down here in the investing activities. I'm showing the increase in accounts receivable. I'm deducting that. Why? Because accounts receivable is a paper gain until I have that cash in hand. A decrease in merchandise is going to be an addition added to, and an increase in accounts payable is added to. If you notice, assets, current assets, when they increase, deduct from net income. When they decrease, they add. And the opposite is true of current liabilities. Current liabilities, when they increase, they actually increase this adjustment. And when they decrease the adjustment. And I would always keep a piece of paper with you that tells you that those behaviors, so that you'll be able to do this operating section. And there's a very good one in the book. There's also an excellent explanation in the book that we'll go through. When you get done with the operating activities, it's going to give you the cash actually supplied here, right here. Net cash provided by activities, right there, $70,000. So you can see already net income shows 40, but this is showing 70,000 in cash actually generated. Then you go down and you look at investing activities where you have either paid for or sold plant assets. And that was a big whopping use of $260,000. So now we're kind of in a hole here, right? If you deduct these two right now, we have a negative cash flow. Then we look at financing activities, and we find out that cash receipt from a note payable, we have a cash payment of a note payable, means we increased our liability on the first one, we paid some off. We issued some stock for $120,000. We repurchased treasury stock. These are all uses and additions to cash, so we come up with $170,000. So look at this. We have a net increase or decrease of cash of $20,000. So we have a decrease of cash flow of $20,000, and then that reconciles with the actual cash balance that we have at the end of the year. We had $42,000. You subtract $20,000, we now have $22,000. Isn't that just a beautiful statement? Even though we did lose some cash flow. So you can see how that tells a whole nother story. If you just looked at net income, you'd say, wow, we're doing great. But when you come down and look at that we had a negative cash flow, then you might want to start questioning some things. So on the operating activities, that's the first section I just showed you, and it reports the activities that created from revenue or expenses of the business. And this is kind of a very important one. How much revenue or how much cash did you generate from revenues and expenses, true cash? So it looks at investing activities also, and that's the second category. And we looked at cash receipts and cash payments that increased and decreased long-term assets. And then we looked at the financing. Okay, that was the very last one. And those include issuing stock, paying dividends, buying or selling treasury stock, bonds, anything of that nature. And here's a final... This really is very handy. I would probably print this off. Operating cash flows comes from current assets and current liabilities. Investing cash flows come from long-term assets. And finance comes from long-term liabilities and equity. This is your balance sheet set up. And at the end, sometimes you will find non-cash investing financing activities that are added clear at the bottom of the cash flow statement. And that gives us, here's some examples of what be investing and financing activities that are non-cash that would have to be listed. And finally, we have the two methods. We have the indirect or the direct method. We're going to stick with the indirect method. Actually, GAAP likes to have the direct method, but nobody uses it because the indirect method gives you the same results in a lot less time. So we're going to look at the indirect method. And that sets us up. Now let's get into the nitty-gritty of it.